Welcome back. I'm Josh Lewis, broker owner at Bywise Mortgage here in Huntington Beach, California, with the mortgage and real estate update for June 29th, 2020. As crazy as it sounds, in a crazy year here, 2020, we're almost halfway through the year, moving into the second half of the year. So we're taking a little bit of a different approach. We're going to quickly gloss over interest rates. As you know, it's Groundhog's Day and has been for months now, and not a lot of movement. So we'll give you a quick update on interest rates, and then we're going to jump into strategies for mortgage independence. In honor of Independence Day, I always like to circle back with our clientele and deliver this message every year. It's an important thing to think of. We always like to talk about how home ownership in the long run is always the right decision for most people. But what does that mean, and how do we maximize its impact on your life? So let's jump in. I'm going to make me a little bit smaller, make the screen a little bit bigger. These candlesticks, my business partner, Scott, likes to tell me, stop putting the stupid candlesticks up there. No one cares. So we're really just looking at the shape of this. You can see this long running trend. So we're going back here to April, May, all of June, and moving into July. What you'll notice here is we have made a nice little run above the 25 and the 50-day moving average. And on the next slide here, just want to point out these green circles. We are nearing that line, that red line there. And every time we've hit it now, going back 1, 2, 3, 4 previous times, we've got pushed back. Rates didn't get bad, they just got a little bit worse. So this will be interesting to see if we can push through it, if we can get past this next level up here at 104, 456. We've got a lot of room to run up above that. So if you've been watching, you know I believe interest rates are great and likely to inch down as we go forwards. I think it's going to take a while for us to get through this level. If we do, I think most likely we'll see interest rates improve as lenders, again, get comfortable with the forbearance situation and realize that they're not going to take big losses on that end and get comfortable with putting new loans on the books to well-qualified borrowers. So what does it mean? You're going to look, these are going to be very, very similar to last week, even though rates technically are slightly better. Conventional loans under 510, 400 at 3.125. Now remember, these are 0 points, no lender fees. You're basically going to pay for an appraisal and credit report, escrow, title, and recording. So if you want to pay more, which we've also talked about in previous reports, there are big national lenders out there promoting and suggesting that everyone should be paying a point or two to buy their rates down. I don't necessarily agree with that, but we can certainly look at much lower numbers than this. We have 30-year fixed rates on rate sheets all the way down to about 2.5% if you want to pay enough for it. FHA and VA both right at 2.75 with actually a small lender credit. We're getting really, really close to being at 2.625 on those standard balance. My source of frustration here in my life is these big loans in Southern California. We have a lot of them over 510, 400. We're at least getting much narrower on this gap. The 30-year is down to 3.375, which is only about 1/4% off. Normally that gap is 1/8%, so we've almost normalized there in terms of high balance. The FHA and VA high balance, especially the VA, don't really know what's going on here, but lenders are just kind of holding the line here at higher levels. So FHA about 3.125 and VA with a half cost. So not even no cost or 0.0 fees like we're talking about, half point cost. We're up around 3.25. And the crazy thing, if you're in that market, you're looking for a high balance VA loan, about every 10 days or so, we'll have one of our lenders go crazy and they'll be 3.125 with a lender credit for a day or two, and then they take it down. So again, not sure exactly what's going on there and why these lenders are coming in and out of the market. But as time goes on, we should see those normalize. So let's jump into the promised highlighted information for tonight, strategies for mortgage independence. What is independence? It's freedom from the control or influence of others. So when we're talking about your mortgage, we don't necessarily mean, hey, let's get the mortgage completely paid off, but limiting the influence of the mortgage and the impact on your life. So let's look at some of the benefits of home ownership. If you've heard me talk before, I don't think we've got into it too much on these reports, but there are some significant benefits to homeownership. Homeowners accumulate greater wealth than renters. Homeowners have a 44 times greater net worth than renters. The last time the federal government checked this was in 2016. So they actually measured it again in 2019. They haven't compiled all the numbers. So we're probably looking at somewhere near a 50 times greater net worth. So from 2013 to 2016, when they measured, homeowners' net worth had gone up to $231,000, which was about a 14% increase. So $30,000, $40,000 increase over the previous 3 years. And renters had exactly the same amount as they had the previous 3 years, a net worth of $5,000. It's a morbid way to put it into context, but just so you know, the average burial expenses for an American are a little bit more than $5,000. So the average renter has barely enough accumulated in assets to pay for their burial when they go. The second major benefit of homeownership is lower housing costs. You're probably aware, depending on where you are in the country, if you go and buy a home and you don't put 25 or 30% down, the mortgage payment is going to be slightly more than what rent is. But these numbers here I want to show. The average United States mortgage payment is $1,029 a month. The median U.S. rent for a two-bedroom apartment is $1,343 a month. So why is that? It's because most people didn't buy their house yesterday or 2 or 3 months ago. They bought it 3 years ago, 10 years ago. Your grandparents may have bought it 30 years ago and have a $30,000 mortgage with a $150 monthly payment. So when we look at that average mortgage payment, it's $1,029 versus $1,343. It's 25% lower on average than the rent. Let's look at that and say, why is that? It's because we have fixed housing costs. And if you're a renter, you're painfully aware that we do not have fixed rents. There is no 30-year fixed rent. 90% plus of the mortgages we do in the US are 30-year fixed. So you do have a variable portion. Your insurance will go up over time. Your property taxes will go up over time. But 80% of the payment, which is your principal and interest in the early years, is fixed. So we also have wealth accumulation in the form of home equity. We have two ways of accumulating that. Every month when you make your payment, we used the example last week of a $615,000 average purchase in California right now with 10% down. That person is paying almost $1,000 a month down in principal every month. So at the end of the year, they're going to have $10,000 to $12,000 accumulated just in principal pay down. In essence, it's a forced savings account. It's a piggy bank like you had when you were a kid with one of those locks, or where you have to hammer the piggy and kill it to get the money out. That's what your house is. It's not super easy to get the money out of, but you're paying it down every month. And then what everyone thinks of in terms of building wealth through homeownership is that the home value goes up over time. We've seen over the last few years 4 to 5% appreciation through most of the United States. Some areas a little hotter, some price ranges a little hotter. The lower end, the first-time buyers, have been even a little bit hotter than that. And the last one, when we talk about the 4 factors that lead to building wealth through homeownership, we talk about the tax benefits. Now, after 2018, we have some significant changes to the tax code that really mitigate this. So I almost want to call it the 3 pillars going forward. Some people will get tax benefits in the form of being able to deduct their mortgage interest up to $750,000 of equity indebtedness and deduct their property taxes up to the $10,000 state and local tax cap. So those 2 caps, and then also the massively increased standard deduction, have mitigated the tax deductions or the tax benefits of homeownership for a lot of people. So what do we want to talk about here in terms of strategies? Strategy number 1, become a homeowner as early in your life as practical. And what do we mean by that? I don't think most 20-year-olds, even if they were financially ready, are in a position to be ready for homeownership. When I graduated from college, moved a couple times, had a different place here and there, you're just not fixed in time. Even if you had the money, you don't know where you want to live. You don't know where a job is going to take you. You don't know where a potential future spouse is going to take you. So we've talked about this. The millennial generation, the biggest generation by size in the United States since the baby boomers, is really getting to that prime home buying age. And it's just life factors. They've gotten married. They're having children. They're at a point in their career where they have stability, both in terms of income and location, where they're like, hey, I've settled. I'm ready to put roots down here. So as soon as you feel that happens for you in your life, become a homeowner as soon in your life, as early in your life as is practical. I need to take that typo down. Every time I look at it, it trips me up. But just think in terms of, we don't want to rush it, but we also don't want to delay it. It's just like you've seen the chart that if you saved $1,000 a year starting at age 20 versus $10,000 a year at age 40, the 20-year-old comes out ahead. You want to get those 3 factors or 4 factors of homeownership on your side as early as possible. So strategy number 2. We always want to talk to our clients about managing your home equity. So what do we mean by managing your home equity? The big one that we're seeing right now, the downside to coronavirus and the economy suffering right now, is mortgage rates are at all-time lows. We've got tons of clients refinancing. And what I say is refinance whenever the opportunity arises to lower your rate with minimal to no costs. You saw in our rate quote, we talk about doing these loans at low to no cost. I see numbers all day, or I see people come in and say, well, someone else told me I can get 2.75. I said, I'll be happy to do the side by side. I guarantee you my 2.75 is cheaper than their 2.75. I'm just saying that's not the right strategy. We don't want to give up 1 to 2 points in terms of a percentage of your loan amount. Even if it's a $500,000 house and you owe $300,000, 2 points that it would take to get you down to 2.625, 2.75 is $5,000 or $6,000. That's hard-earned equity. Don't necessarily want to give it up without strongly considering it. So refinance whenever the opportunity arises with low to no costs. Don't take cash out for frivolous expenses. We don't see this a lot, but one of the reasons why the millennial generation was gun shy about home ownership and waited later in life is they saw the previous generation do things like taking money out of houses for vacations, for boats, to pay off credit cards, to only run the credit cards back up. Your home ownership should be a locked box. Your home equity should be a locked box. When you accumulate it through capital appreciation, through equity pay down, you shouldn't touch it unless there's a very important reason. So I say shouldn't. If you get to a point where you need to send a child to school, if you have an important medical expense, there are things that happen in life that can be an excellent way to finance, but we just want to be strategic about it. That's why I'm saying manage your home equity. The last thing, I'm saying manage your home equity. I drove through a neighborhood like right across the street from mine. And there's actually 3 neighborhoods. There's my builder, and on the other side of the street this way, and on the other side of the street this way, it's a different builder. And those homes are equally as nice as ours. But our neighborhood is a little smaller, and I'm more familiar with that. And I'm more familiar with the one on the other side. And we were just out riding our bikes and drove through this neighborhood. And I was struck by how less well maintained those homes in that neighborhood were. And I'd always known that homes on that side of the street sold for less. Now, part of that is a school district for the elementary school. One side of the street is better. But I can tell you, having gone through that neighborhood, absolutely the lack of maintenance in those homes, lack of upkeep, pride of ownership. So you have that obviously in your neighborhood. Pick a neighborhood that has pride of ownership and that people care for their homes. But also you be the person to care for your home so that when the time comes to sell it, you get a premium for your house instead of having to sell at a discount. Some of you may or may not know, from 2008 to 2011, when the market was in the tank, the primary source of my income is we flipped over 40 homes. A partner of mine and I did. And we weren't out looking for the pretty homes. It was rare that you would find a pretty home that was in distress, that went to foreclosure. And if it did, that was the first one to sell. The homes we were picking up at the big discounts were the ones that were neglected and not treated real well. So refinance when you can to lower your costs. Don't take cash out for frivolous reasons. Maintain and improve your home to maximize the value. So strategy number 3, this is one that everyone's familiar with. We want to talk about it in a couple different ways. Accelerate your repayment. We want to pay that mortgage off. What's the easiest and simplest way? You have a mortgage now, make additional principal payments each month. If you add 1 payment extra a year, so if you paid every 2 weeks, it would be 26 half payments or 13 payments. That'll shave about 6 years off the life of the loan. But it doesn't have to be that number. You can put an extra $100 every payment, an extra $1,000 every payment. We also can look at right now, when we're in a big refinance boom and everyone's refinancing, look to reduce the term of the loan. You can go with a 20-year term, a 15-year, a 10-year term. what a lot of people don't know is you can get custom terms. So maybe you took your loan out 2.5 years ago and you're saying, I can't afford any higher payment, but I want to take advantage of the lower rates. Well, let's do a 27.5 year loan. So you're not giving up your 2.5 years of payment and still moving forward towards your mortgage independence. The last option I like to talk to people about is if you are a disciplined saver. The reason why I say disciplined saver is if you're not, money that doesn't go into the home has a way of disappearing. The reason why homeowners accumulate more wealth is they don't have the option of spending that money. They start out with a payment a little bit higher than rent in most areas, but it goes into a lockbox and it doesn't come out easily. So if you're disciplined and you're good at saving and you're good at investing, consider building an offset account. So instead of going to a 15-year payment, which with rates as low as they are, going from a 30-year to a 15-year is going to have a 35% increase in the monthly payment. Put that money into an IRA. Put it into your 401k, maximize your savings, because that growth over time will pay you back more than paying the loan down. But again, it's only for people that are really disciplined. So the last option I want to throw out to you here, strategy number 4, is buy additional real estate or convert your home to a rental when you move up. I'm talking to some folks today, actually friends of my business partner, Scott's, a past employee, and they are looking to move up to a home in the same neighborhood. And we're running through the numbers, and they can keep their home, their current home. And we've seen over time, that's the easiest way because they already have owner-occupied financing on it. They didn't lie to anyone. They did owner-occupied financing and they live in that home. When they move up to a bigger home, they can get owner-occupied financing on the new home. Now they have 2 homes with really low interest rates, with manageable payments for them. It'll break even on their old home and they can afford the payment on the new home. And what they're going to have is 2 leveraged assets with borrowed money that they get all of the appreciation. So for their situation, it's a $500,000 house they're moving out of and want to rent, and about a $650,000 house that they're going to move into. They're going to control 1.1, almost $1.2 million of real estate. So if we get 5% appreciation this year, or say even 4%, they're going to have $40,000 or $50,000 more net worth at the end of the year. And they're also going to have paid both of those loans down to the tune of another $15,000 or $20,000. That's $60,000 of additional wealth their household will have. So you're using other people's money to control that asset. Someone else is paying you rent to make that payment. The bank is financing that for you, and that rent is paying back both the principal and the interest on that loan. We don't have a lot of clients do it, but the ones that we do build up equity and wealth faster than the others. So again, just wanted to leave you guys with that concept of mortgage freedom, mortgage independence, and being here this time of year, every 4th of July, where we're all focused and well aware of independence. But what does it mean financially? What does it mean for you? We all are going to get to a point where we're old and we don't want or are not able to work anymore. And the biggest burden, the biggest expense all of us have is the roof over our heads. So let's make a plan. Let's become a homeowner. Let's have a tangible asset. Let's pay it off over time so we can all arrive at home at retirement with true freedom. So hopefully that was helpful. Hopefully you guys enjoyed it. It's a little bit of departure from what we normally do. I know we went a little bit long here. I try to keep these at 15 minutes. We're about 18. But thanks for tuning in. Have a great night.